This is Matthew Cratter from Trader University, and today I want to talk a little bit more about how trapped the Fed is and what's about to happen to the stock market and the financial markets this summer. So this week we got some very interesting economic data points. One of them is that U.S. consumer sentiment hit a record low. This is really an unbelievable number when you look at the chart. So this is a sentiment indicator that's put out by the University of Michigan, where they survey consumers and see how they're feeling about the economy. In June, it tumbled to 50.2. And if we take a look at the long-term chart, this is the lowest that it's ever been. It fell down from about 59 down to 50, as we said. The previous lowest point was, call it 52, in April of 1980, when we had double-digit inflation and we're on our way to double-digit interest rates. So this is quite a reading. It's completely off the charts, and it shows how upset the consumer is. We can expect consumer spending to fall and the consumers really to rein in their plans. We can see when we look at the inflation numbers why this is true. Here's a good summary from Heather Long at the Washington Post. Groceries up almost 12% year on year, the biggest increase since 1979. Chicken up 17%, the largest ever increase. Restaurants up 9%. Electricity up 12%. Airfare up 38%, the largest hike in airfare plane tickets since 1980. So this is really across the board. This is why we were able to see such a high inflation print on Friday, where the CPI rose 8.6%. May over May from May of last year. And this understates the true rate of inflation, as we're rapidly learning. This has been a fake number. And so the actual inflation rate is probably more like somewhere between 10 and 20%, depending on what you spend your money on. Now, there's a bigger problem, and this is where I want to talk about how the Fed is trapped. We had a couple months ago, on May 10th, we had this tweet from Carl Quintanilla of CNBC, talking about how Janet Yellen said that tax revenues were very strong. Now, this is always a lagging indicator. Tax revenues that come in now are the result of income or capital gains from months ago, sometimes even 12 months ago. So as of May or April, tax revenues were still really strong. And what I was talking about at the time is this was really a lagging indicator. And with the collapse in stocks that we'd seen, here's a chart of the QQQs for 2022, and there's obviously a lot of things levered to these indices, the SPY and the QQQ and the IWM, etc., that this is really a leading indicator of tax revenues. Tax revenues will fall as people make less money in the stock market. And this is, in fact, what we're seeing. We had a great tweet from Harold Malmgren a couple days ago saying that Lee Adler has done some research and is able to pinpoint that federal tax collections plunged in May. So we have this problem, which is really a deficit problem, which we're going to talk about. And the problem is that the U.S. government needs to finance itself, of course, and the rate at which it's financing itself has been moving up with these inflation prints, as traders and investors realize that the Fed is going to need to continue to tighten, or at least this is the projection. And so we saw on Friday the 2-year note, the 2-year Treasury note, go over 3%. It hasn't been this high in a very, very long time. And one way to look at this chart is to think about it in terms of government financing costs skyrocketing. I could look at the 5-year note as well. I have the 10-year note here as well. Whatever maturity the government's financing itself at, these interest rates are going up, which is making it more expensive for this U.S. government to roll its debt and continue to finance itself. So what do we have here? This is the debt clock. We have interest on the debt right here. This is going to be moving up with interest rates as the U.S. government rolls its maturing bonds into new bonds at higher interest rates. We can't really change defense, war, spending numbers because of the situations, with both Russia and China. Social Security and Medicare can't be cut, or you'll have complete riots in the street. And so we have interest on the debt going up, all these other things either going up or staying the same, certainly not going down. And then we have federal tax revenue plunging, with tax receipts plunging because all the asset prices, housing prices, stock market down. So what this means is if you don't decrease your spending, but you decrease the money coming in, it means that the budget deficit is going to explode. This is the difference between tax receipts and what the government actually spends. So lower tax receipts and higher financing costs because interest rates on U.S. debt are moving up. This means larger budget deficits. Again, we have lower tax receipts coming because of the carnage in the stock market and perhaps coming in the housing market. Larger budget deficits means that the U.S. Treasury needs to issue more debt to plug that hole. If you can't cut spending, just like a household, if you can't cut spending, it means you need to run up your credit cards or borrow more. And the U.S. government never cuts spending. So this means larger budget deficits. This means more debt. More treasuries need to be issued. And there's a real problem. Who's going to buy that debt? It's not going to be Russia after we froze their FX reserves. It's not going to be China after they saw us freeze Russia's FX reserves. It's not going to be Japan, which has their own problems with their currency and trying to manage exchange rates. U.S. bank balance sheets are not big enough to buy all these treasuries, all this U.S. debt. Guess who is still the only buyer of last resort? It's still the Fed with their money printers. For now, they're tightening. They're very hawkish. They're going to keep raising interest rates. They're going to let their balance sheet roll off. But this is not sustainable because of the U.S. fiscal situation, because of these huge budget deficits. And if we enter a recession, obviously tax revenues will fall even more, and the government may need to spend more to pick up the slack in sort of using sort of the Keynesian stimulus model. So there's no question that the Fed will need to turn the money printers back on, if for no other reason, to finance the U.S. government and its spending. It's just a question of how much pain, economic pain and political pain, the current administration and the Fed are willing to endure. Are they actually willing to let stock indices fall 50%, 60%, as they did in 2000 and 2002 and 2007 and to 2009 in the great financial crisis? This would be a very tough pill to swallow, especially because debt to GDP numbers are now much higher than they were in either 2000 at the beginning of that bear market or in 2007 at the beginning of that of the great financial crisis. So we can see in 2000, debt to GDP levels were roughly 55%. In 2007, they're roughly 60%. We're basically double that now at 123%. And once you get over 100%, over 120%, it becomes very difficult for governments to come back from this. They usually have to resort to extreme money printing and some form of very high inflation, even hyperinflation. So my guess is this is what happens. My guess is that something big breaks over the summer or in early fall from the Fed being as tight as it is. And that will force the Fed to reverse course, print up some more money, and buy government bonds to help to finance the U.S. government. I think the Fed reversal probably happens in September or October, if not sooner. What do I mean by something big breaks or something big blows up? I mean something in the U.S. financial plumbing bursts. Maybe we have a problem with the money markets again. Maybe there's some sort of bank run. Maybe the repo markets have liquidity problems. Maybe the treasury markets have liquidity problems. Maybe even a couple large companies blow up, large employers blow up. We're at a very interesting point, and I urge you all to be really careful, because what we're seeing, the great Warren Buffett saying that when the tide goes out, you see who's been swimming naked. And I remember this very well from the 2000 and 2002 bear market. As this happened, Enron blew up, and we began to see the fraud that was occurring at this energy company. The same with WorldCom, this telecommunications company, as a long-distance telephone company. They also blew up during this period in time. And this is why you have to be very careful what you own when the Fed is hiking and things are blowing up. This is why I warned you all about Terra Luna, and I warned you all about Celsius as well. It looks like what I said about Celsius is coming true, down more than 50% just in the last couple days, down 26% overnight. We're also seeing some really weird things happening with Ethereum as well. We're seeing Ethereum fall much, much faster than Bitcoin. So there are definitely problems in Ethereum land and DeFi land. But it's very important, if you own stocks, if you own crypto, to know exactly what you own. In the crypto space, in my opinion, the only place to be, obviously, is Bitcoin. But we're going to continue to watch this. the fact that this inflation turned out not to be transitory, it's proving very sticky, means that the Fed is really between a rock and a hard place. But ultimately, I think they will choose inflation over deflation. When you have such a levered economy, when you have debt to GDP levels so high, you cannot risk a blow up. You're going to need to pad the fall and turn those money printers back on, probably in the third quarter of this year, unless something really big blows up sooner. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.